Welcome to another episode of What's on Your Mind, a show hosted by the Institute of Trading and Portfolio Management, where we'll be talking to the Institute's senior trading mentors about what's been on their mind in the financial markets. I'm Chris Quill, and today I'm joined by Hichem Djouhri and Anthony Iser. Now, just before we jump into the show, I want to remind you guys watching that if you want to learn more about trading or more about what the Institute does in general, then do head over to our website itpm.com. And from there, you can see a lot of different links to various educational resources. So things like our upcoming live seminars, our online education courses, bite-sized videos, and mentoring programs that we do around the world as well. So with that being said, let's just jump straight back into the show. And Hichem, I think we'll start with you this week. What's been on your mind?
Sure, guys. Just we'll take you on a little tour around the world, essentially of what's happening. From a macro perspective, global growth still remains solid. We have seen a slowdown over the last month, particularly in Europe, China, and emerging markets. The US remains sort of the bastion of global growth, even though we've seen some softer data and tighter financial conditions. With the recent market turbulence that we've seen, financial conditions remain accommodative and fiscal policy will remain supportive. And as long as Europe and China manage their slowdowns, the world economy should be able to maintain a steady growth. EM growth has moderated, but it hasn't totally collapsed just yet. There are opportunities there, which we'll touch upon a little later. Aggressive quantitative tightening, political risks such as Brexit or the Italian debt situation now, and any sharp correction in financial markets. These are the major, really downside risks that we see. From a macro perspective. Moving to the US, so Q3 GDP is growing at an annualized rate of about 3.5%, 2.1% of which is attributable to inventories, and capex, however, only contributed about 10 basis points, which is minimal. So that's something that we need to see pick up. That being said, the outlook still remains strong over the medium term. Growth is expected to accelerate by about just under 3% for this year, and this is boosted mainly by tax cuts, fiscal spending, and rebounding consumer spending particularly. There are some downside risks on the rise in the US, mainly in the form of tighter financial conditions due to the Fed rate hikes, and we'll talk about the ones that are expected over the coming year. Also elevated corporate debt levels and the sort of the elephant in the room, which is the uncertainty around trade policy. In the EU, so that the health of the euro area recoveries come under scrutiny in the past 2 to 3 months particularly. So this was reflected by disappointing Q3 GDP number, which was 0.2% Q on Q. So the 2-year lows came from manufacturing and the composite PMIs in October. So these surprise indicators are moving back into meaningfully negative territories, and the data flow suggests increasing downside risk to near-term growth. Stronger wage growth still, however, and still easy financial conditions point to domestic resilience, but the credit flows are flat since the beginning of the year, and bank credit has turned from a support to an area that could be problematic for 2019, and it's going above consensus growth expectations. Growth for 2019 euro area is expected at about 1.7%. Moving to China, Q3 real GDP growth slowed to 6.5% from 6.7 in Q2, which is just under consensus at about 6.6. And this was mainly driven by lower industrial output from auto production and weak construction activity. Q4 started on a better note, let's say, with the latest data showing some resilience. The October exports and industrial production came in stronger than expected, although weakness in auto sales continues to be trend there. Manufacturer sector investments also strengthened to about 9.1% year to date in October. So the government may keep the current policy stance in Q4 as growth is on track to achieve the annual growth target. Investors can expect some risks from exports and the land market. Furthermore, the recently announced personal income tax cuts are estimated at about 0.5% of GDP. So this should boost retail sales and help offset some downside risks to growth from the trade war. And lastly, just on emerging markets, so the growth fears there have been postponed for now. Policy responses from central banks have been really the most important thing, as in the case for Turkey, which have been reassuring. but a long and increasingly risk adjustment lies ahead. So that's something to watch out for. The backloading of recession fears may also pave the way for a technical rebound. However, there's really no room for complacency as volatility is set to increase and the funding bar is raised significantly. So here you need to differentiate across cycles. Latin America has brought good and bad news. So it's been a mixed bag there. Brazilian election outcome has opened the door for reforms, while news flow in Mexico is a bit concerning. In EMEA, the activity there has been softening, particularly in Russia due to further sanctions from the US, and confidence has obviously dented Turkey's growth dynamics. And in Asia, policies prioritizing growth. So this is sort of what we're seeing globally. In terms of monetary policy, as we had mentioned earlier, so we're expecting one more rate hike in 2018 and 4 hikes in 2019. On the ECB, QE should end by December 2018, and then we should see the first 15 basis point deeper rate hike in September 2019. In Japan, there are discussions over the medium term on changing the policy goal from inflation to growth or price levels. And the Bank of England saying that there will be no more hikes in 2018 as growth and MPC focus now on the Brexit developments, which is really center stage currently. So really in terms of macro, this is what we're seeing now.
Yeah, cool. I mean, that was a great kind of update on what's going on all over the world, really. Anthony, bringing it to you for a little bit. Is there anything, any sort of part of that you're particularly interested in, macro-wise?
Yeah, there is, Chris. I guess the way I've been thinking about things is trying to find the big levers. And if you think about a stock and its performance or its earnings, they've got a range of levers they can pull. The industry has levers, headwinds, tailwinds. A country does as well. But the biggest one, obviously, is the Fed and what's going on with monetary policy. And last night my time, Chairman Powell updated some comments about the outlook, and people really latched hold of those comments. Saw markets performing a little bit better and yields coming off. And I guess the way I look at that big lever, the Fed's sitting there looking and trying to work out if they've got policy right, they're relaxed. But so they're thinking, what are our risks? We're either too tight or we're too loose. And perhaps those comments overnight where Powell suggested that they were just below the normal range might be interpreted as being a little bit worried that the Fed could slow growth by being too tight. But I think the key factor is he said it's below the normal range. And what is the normal range? It's 2.5% to 5% historically. So there's no indication that you're going to reach the bottom of the range and he's stopping there. I think it's a little bit of jawboning, just trying to take the heat off the market. Broadly, I think they would still be thinking that the risks are to the other side, that this Goldilocks period of low inflation, low unemployment rate and good growth, that the risk is inflation picks up, given how loose policy has been for a decade now. And so one of the things I was looking at, Chris, and this is what I guess some of the key economic factors that the Institute looks at, trying to determine what's going on and which way directions of Fed policy and economies and markets might be. Looking through the non-manufacturing and manufacturing PMIs, and there were some comments in there. Then I'm just going to read a few off because I think they're very relevant to what's going on. And these are underlying comments from players in the sectors. So there was comments saying increased costs from tariffs are getting passed through. That was from the food and beverage sector. Supply chain is stressed, demand is high, transport manufacturing sector. Tariffs are causing inflation from the chemicals manufacturing sector. Tariffs are increasing costs and drivers are hard to find. Finding workers are hard to find. That's petroleum, and it's also the professional and science and technology sectors. Labour is in short supply, says the public administration sector. Inflation and wage inflation. There's no signs of these coming through, but these comments suggest that with inflation at sort of 2.7%, unemployment rate well below historical levels at 3.7, these comments suggest those risks are to the upside, and we potentially could see what's been missing, which is wage inflation. So that's the one specific thing that we've talked about. Hichem, you're outrageously comprehensive in everything that you went through. And I guess, I'm sort of getting very narrow in my focus and just trying to work out where the Fed's at, because this is a transition period at the end of a 10-year economic cycle, and whether it goes on for another 3 months or 18 months, I've got no idea at this stage. But I think the clues will come through this economic data and what the Fed moves are.
That's an interesting point. I mean, again, it has been a little bit of a theme in our What's on Your Mind episodes about coming to the end of the cycle, or things are starting to kind of look like we might be going through a later stage. But Hichem, is that something that you're also kind of in agreement with, or are you looking at things that way? What do you think?
I mean, what's interesting now is really, you've seen global risk assets. They've had a rough start to the fourth quarter, so there's been a lot of risk-off sentiment. We've seen U.S. and international stocks fall sharply. Markets seem to be ignoring any strong economic data due to the trade tensions and future earnings uncertainty. So we've seen the S&P having its largest monthly decline in 7 years. So the market volatility has come back. The S&P moved up or down by more than 1% in a single day on 10 occasions last month. That's twice more than the whole of 2017. And the S&P ended the month down just under 7%, which leaves the index up about 3% year to date in total return terms. Internationally, equity markets also fell that month, and despite the risk-off sentiment, the global aggregate bond index was down by 1.1%. So there's no real clear catalyst for the movement in broader asset classes, although those who do have a negative take on the market are not short of excuses to sell the market, so to speak. You have the argument really is that central bank balance sheets are unwinding, tariffs, concerns over global growth, too optimistic earnings expectations. Basically, there's no real room for surprises to the upside in terms of earnings, and rotation taking place from high growth to defensive and value picks. And what we've seen around the U.S. midterm elections was also a reason for a pickup in market volatility. So all of these reasons have led to a repricing of risk. We've seen a rise in the VIX index and also credit spreads widening. So as long as the repricing of equity valuations takes place, the S&P was down about 10% from peak to trough, and valuations are down about 20% in terms of PE, going down from 19 to 15 times. So the question really here is for investors is whether this decline is a healthy correction within a bull trend, or the start of something more serious. There's a chart that I would like to share with our viewers, just to paint a picture based on history. So these are examples of large market corrections which didn't lead to an economic recession, despite the declines ranging from 15 to almost 30%. Having said that, it's worth highlighting that each of these market corrections or crashes proved to be a buying opportunity for stocks. So there are a few reasons for that. Try to go through them as quick as I can. So you have global manufacturing, non-manufacturing PMIs, as Anthony was saying, are solidly in expansion territory, and the latest PMI surveys show that global economic growth has been moderate during the third quarter. Global PMI remains in expansion, so we're above 50, even though there's been a softening there. Higher energy prices have lifted headline inflation rates globally over the past 6 months, but core inflation remains below central banks' targets in most of the global economies, particularly advanced economies. So the key positive from that is that there's no really risk of an overheating in the coming quarters. In terms of earnings, global earnings remain solid, particularly in the U.S. market, which has stood out in 2018. The rest of the world has been underperforming vis-a-vis the U.S. In terms of acceleration of earnings growth. And what we're seeing is that U.S. earnings growth should decelerate versus 2018, but it's still expected to remain at a healthy level. The earnings growth for the three zones, so the three main zones, should grow at an average by about 10% next year, which is still a solid rate, and it's not a recession or a bear market necessarily. Global rates are on the rise, so monetary policy is very far from being restrictive. Long-term bond yields are low in absolute terms. Long-term bond yields have diverged amongst advanced economies in the end of Q1. So early November, the 10-year U.S. Treasury rose by about 3%, while yields on German the 10-year bonds dropped by 25 bips to 0.4%. And the Italian sovereign spreads have widened considerably. So really the main positives here is that the cost of debt servicing remain contained, and this is an important point given the considerable amount of leverage that still remains in the system. And risk premium remains attractive for equities, which is really the main point that I want to talk about in terms of equity valuations, which I think are reasonable where they are today. So yes, the U.S. market is not cheap and is the most expensive in terms of equity markets globally at this stage. But we shouldn't forget that U.S. equity valuations relative to bonds remain attractive. So the S&P risk premium, the earnings yield versus the 10-year Treasury yield remains at around 250 basis points. So on an absolute level basis, the S&P looks expensive when looking at the Shiller PE, which is at about 31 times, and price to book, which is at 3.3. But there are some explanations to this. First, the Shiller PE looks at the last 10-year earnings, and we shouldn't forget that the U.S. went through an earnings recession in 2014, 2016. Also, the price to book needs to be put into the context of the larger index weight of growth stocks, for which the price to book ratio is not really a reliable metric. So, S&P valuations remain below the 20-year average on a trailing PE basis and on a forward consensus basis. So the two main important points to consider here is that first, the growth cycle is trading at a substantial premium to value. Even though the US market is in aggregate not cheap, there are still some pockets of value. The second point is that the US is trading at a premium to the rest of the world, which means it's possible to find some markets which are more attractive, which have more attractive valuations. For example, the MSCI Emerging Market Index is trading at a PE of 10.7 on a 12-month forward basis, which can't really be looked at as expensive, really.
Yeah, I think it's kind of an important point as well. I mean, those are some great points about the valuations as well, not necessarily being as overextended as they might seem because of the various reasons that you said, like the growth stocks for the price to book and so on. But I think it's interesting for our listeners, for retail guys, when we talk about perhaps coming towards the end of a cycle or something like that, it certainly doesn't necessarily mean you go short, or you go short to get ready for the next part, because there's stages of the cycle, right? So it could just mean reallocating some of your capital or reducing exposure and things like that.
Exactly right, Chris. And I think that's the key thing that I took from what Hichem just mentioned, was the increase in volatility. And so the students that I talk to at the Institute are winding back their exposure at the moment. It's a period of volatility. You reduce your broad exposure. It's a period of uncertainty. There's not the clarity in market direction that there has been at various points in time. So that's the key thing. This is when you focus on risk management and portfolio construction and reduce those risks, so that you don't need to have a strong conviction whether the market's going up or down, because we're trying to build market neutral portfolios at this point in time. And at this point in time, we're very neutral. There will be times that you think, okay, I'm going to be long. I've got a whole range of reasons to be bullish. And I just don't think we're in that point at the moment. And I don't think we're in the period, as you said, Chris, that you sit there and say, okay, let's go and short everything straight away. But we're somewhere in that transition, which can take an awfully long time and see, very big swings both ways. I would disagree a little bit with Hichem in terms of valuation, though, because I think valuation is only credible at the moment if interest rates remain at these levels. If you see interest rates pick up by 1 or 2% over the next year or two, then the market's expensive. That's just the nature of discounting those future earnings. And but if we see interest rates remain at these levels, if people are right that the Fed is tempering their outlook, then the market represents reasonably good value if you trust the levels of growth and earnings. But if they remain on track to raise rates in the way they expect, then there are risks to the downside in terms of valuations, I think.
Sure.
Yeah, I mean, we're definitely moving into a new normal. So it's natural for volatility in both the economy and asset prices to rise through this transition place as we're getting deeper into the bull market, which is basically what I'm trying to say is that it's getting a lot more mature here, and market corrections are likely going to be a lot more frequent. So going forward, investors can expect forward returns for equities to decline as real interest rates rise eventually from below zero, which is where we are effectively. So again, we do expect volatility to continue to pick up, correlations amongst financial assets start declining, and dispersion of returns in stocks to diverge. So basically, in a nutshell, it should be a great environment for active management. But as Anthony was saying, that needs to come with a lot of risk management as well. So given that the market has become or the bull market rather is in a more mature stage, one of the key consequences of Trump's fiscal stimulus agenda is that we're moving from a sole reliance on monetary policy into the inflation phase. So this implies that you don't have a Powell put, which means that investors can't rely on the Fed to support the market, as has been the case over the past few years, in a similar way to the Bernanke put or the Yellen put. And this policy transition can be seen to a certain extent, again, as the new normal.
Yeah. So we're running slightly tight on time, but what I do want to go into with you guys is try and narrow it down, get a little bit more specific about some markets outside of the US. So I think, Anthony, do you have some things that you wanted to say on Australia?
Yeah, Chris, I do. And again, it just starts from the top down, the geopolitical situation. So there was an election in Victoria on Saturday. It was a huge swing to the left. And you're going to see a progressive Liberal government, Liberal in small L Liberal, in Victoria for at least the next 8 years. They've got such a majority, and it's every indication the same thing's going to happen at the federal level. And Australians are not happy with the climate change policy of the current Conservative government, the kicking out of Malcolm Turnbull recently, and the sort of more vocal religious right, which historically has kept their mouths shut in Australia and kept their sort of thoughts and prayers behind closed doors. But most people in Australia are not interested in that sort of stuff. So you're seeing a big move towards the left. And what that flows into is policy changes around housing, potentially, particularly tax on housing investment. That would lead to changes in housing demand. It would impact bank stocks. So one of the things that is on my mind is what happens to those stocks, and Westpac and Bendigo are two that I'm looking at under that scenario. And there's an election next year, and it'll take some time to play out. But that looks to be the way it's going. So that's one interesting thing that's going to see on the back of the Royal Commission into the financial services, that the housing market and bank stocks could be under continued pressure. And then just separately, just one cautious thing. Lots of people are looking for yield at the moment, or finding attractive yield as share prices decline. And I had one student bring up GE saying it's yielding 6.2% at the moment. But this time last year it was yielding 4.5%, and people probably thought that was a flaw, but then the dividend got cut and the stocks halved again, and there's nothing to suggest the dividend at GE is safe. So those yields can be very misleading, and so just to be very cautious with that. And I guess just a final point on volatility, and Hisham's mentioned it and provided a whole range of indicators showing how much it's increased recently. You might have seen that YouTube guy who blew up $100 million picking up pennies in front of the steamroller by selling options. And selling options can look like free money for a lot of the time. But when it goes wrong, it goes very wrong. And that's what's happened with volatility in the market. I'm sure this guy had a plan, but as the great philosopher Mike Tyson said, everyone's got a plan until they get a punch in the face. And, unfortunately, this guy's investors got a big punch in the face. He got a massive punch in the face. And there's $100 million down the drain because of volatility and poorly thought out positions.
Hichem, is there anything you wanted to jump in with that's a little more focused?
Sure. Yeah, sure. I mean, the trade that I've been thinking about is Egypt, actually. So Egypt was really the darling of mean equity investors between January of 2017 and April 2018. The index made gains of about 65% in dollar terms during that time. But since then, the pressure on emerging markets that we've talked about on a few occasions now, currencies and equities and stronger oil prices have been taking a toll on Egyptian equities. So they've entered a bear market, fallen about 30% again in dollar terms from the peak of the end of April of this year. So giving up essentially all of its gains year to date, and it's outperforming or underperforming rather the region. So there are definitely a lot of interesting opportunities there. There's a strong IPO pipeline that's coming in. There's a lot of it's a governmental agenda to list a lot of the state assets, and there's a lot of unlocking of value that's taking place there. So there are definitely opportunities. There is growth in the market. I mean, the population is huge. So when you talk about consumers, there's been a lot of initiatives from those companies in terms of cost cutting. And we see a lot of earnings improvement in that sector. So real estate as well is a market, because the Egyptian market, for our viewers who are not familiar, has a lot of inflation. Inflation rate is very high there. It's in the double digits. So what people do is they tend to park their money in real estate, and the real estate market has been doing quite well. So investors can gain exposure to that via the market.
Yeah, cool. All right, well, I think we'll finish up there. We've just about run out of time. So thanks, guys, Anthony and Hichem, for joining me on the show and sharing your thoughts with us again. It'll be great to catch up in a few weeks' time and see how things have progressed a bit. But just before I end the show as well, for you guys watching, just want to remind you that if you do want to learn more about trading, the sort of content that we cover in these episodes, or just about what the Institute does in general, then head over to our website, itpm.com. From there, you'll be able to see lots of different resources to educational things like our upcoming live seminars, online video courses, bite-sized videos, and mentoring programs that we do around the world. So those are with guys just like Anthony and Hichem, and we've seen really great results from guys that have gone through that program, really accelerated their learning and got them some better returns quicker, basically. So that's all from us. I hope you guys enjoyed the show, and make sure you tune in next time for another episode of What's on Your Mind.